Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the digital asset market. And for those who prefer to read, you can obviously go to our blog on our website, ar.ca/blog, where we have similar but slightly different in written form. As always, before we start, this is not investment advice, though we will talk about the markets. And I am joined by my friend and longtime colleague, David Nage. Hi, David.
Thanks for having me, Jeff, and I appreciate the time to go over, obviously, some of the things that we saw in 2024, and obviously, anywhere, anytime, I'm willing to jump on the call with you. As you can see, I'm in the car.
Great. So let's dive into it. Before we get started here, for those who watched this last week or read it last week, I mean, the crypto market is just losing its mind on dumb things right now. This is probably the most bifurcated in terms of opinions. I think there hasn't really been that much impactful news in the last week and a half, but pretty much anything that has come out has just basically validated whatever opinion people already had. If you're bullish, plenty of reasons to be bullish. If you're bearish, plenty of reasons to be bearish. I don't think anybody's really changing their mind based on what's come out. But the one thing I do want to refute is a lot of people talking about, this being the top of markets, not just in crypto, but in equities as well. Talking about massive crashes that are going to come. Certainly the big move yesterday in AI stocks and AI tokens related to the launch of DeepSeek and its success certainly didn't alleviate some of those fears. But I got to just back up for a second. I mean, first of all, credit leads all financial crises, and credit spreads are at the tights. So if you're looking for, actual evidence of, things kind of breaking, there's nothing breaking right now, right? The market being overvalued is different than things breaking. Certainly things can go down if the market is overvalued, but it's very different than like an Armageddon crash. So let's erase that one until we see something happening in the credit markets that would spark any real fear. Second, I think the bifurcation in crypto is what's really weird, right? I mean, 2024, everyone's acting like this is some massive bull cycle. 2024, more than half the market was down for the year. In 2025, obviously no different. You've got things like Bitcoin and Sol that are doing well, and pretty much everything else is down 20 to 30%. But even week over week, you just look at last week. Bitcoin was basically flat, ETH was flat, Sol was flat, Aave was flat, Hype was up a little bit. Like, just because your meme coins and other, valueless tokens are getting crushed, which they should, oftentimes, because there's nothing backing them, right? These are just lottery tickets and fun. That's different than the whole market crashing, right? You look to the kind of market leaders when you're making a statement like that, not the bottom of the barrel. So certainly not any signs of an apocalypse from that standpoint. And third, the president of the United States followed through on pretty much everything that he said he was going to do with his executive orders. A lot of it being very friendly and favorable for crypto. So, it may take time for price to catch up to the pro crypto advancements, but if you're just looking at App Store rankings, I mean, 7 out of the 10 top financial apps in the App Store right now are crypto or crypto related. So I don't really know why the market's so on edge right now, other than just, the fact that this is a lot harder than it was 4 years ago, right? Pretty much any idiot could log on to Coinbase and make money in 2021. Now you got to actually do research. It's bifurcated. It's very different. So with that in mind, I think the liquid markets are probably overreacting. But I want to bring David on specifically to talk a little bit more about not just the liquid markets, but liquid markets and private markets, what we're seeing in venture. And, again, I've mentioned over the last couple of weeks the potential impact of the executive orders and the Trump presidency and the Republican Congress as it pertains to a lot of the liquid investments. Let's take a step back, David, and look more longer term, things that, don't have an immediate price and scoreboard every minute. What does some of the things you've seen out of Washington mean for the long-term viability and growth of the space?
Yep. So let's talk about what's happening in venture in 24, and let's obviously lead into the EO into what I think some of the long-term impacts are on this. And long-term could be 6 to 12 to 18 months, we'll call it. Obviously in crypto that is infinity. But 6 to 12 to 18 months, let's talk about that. But 2024, what we saw in crypto ventures, we reached about $11.5 to $12 billion in total allocation. This pretty much is almost about an 8% increase from 2023, which is great to see. But it's still lower than what we saw in the 21 and 22 cohorts, where we saw roughly $30 to $33 billion each year deployed. What we saw, if you start to really look quarter over quarter, you saw a lot of, the kind of rhyme and reason of gaming, NFTs, layer 2s, and Bitcoin became a big thing in Q1 and Q2. Everyone had a Bitcoin L2 or a Bitcoin DeFi project. For the allocation side of things, you saw about $2.5 to $3 billion, give or take, every quarter. But then in Q4, you definitely saw a notable markup where you saw about $4 billion deployed across deals. And so this was a good way to end the year.
Do you think that was because investors got a little more bullish post some of the election stuff, or do you think it was because there were more companies looking to fundraise on the heels of that, or a little bit of both, or was this really maybe unrelated to the election, which happened halfway through the fourth quarter?
Yeah, I would say that you definitely saw a sentiment pickup amongst conversations that we have with other VCs and investors in the space on the private side. What's happened over the last few years, and we'll talk more about that, is that with the regulatory kind of abyss that was here in the United States, there was a lot of things that were locked up. You couldn't necessarily feel good about tokens being created in a ecosystem or a project. You couldn't even really feel comfortable talking about the idea of tokens without the idea of potentially the SEC knocking on your door. And so I think what happened is that there was a bit of an unlock during the election, and people started to think that things were going to change, and we already saw evidence of that. Throughout the year, you started to see, tokens start to come back slowly in the middle part of the year. There was, what I say is perceived wins with the SEC versus Ripple and the SEC versus Coinbase. You also had the ETFs on Bitcoin and Ethereum, really kind of stoke people's belief that the regulatory climate was changing here in the United States. So you started to see that. And one of the things I talk about, in our writings this week is that there was so much supply that started to come on in 2024 because it's been in these vehicles, these safes plus these warrants that are kind of the predominant funding vehicle for the last few years. So you had a lot of projects that were stuck as safe and warrants, and they wanted to execute and create tokens in their ecosystem to further decentralize and create the incentive mechanisms that they could. So it was a whole smattering of things where you had a lot of supply coming into the market, not enough demand. But then you had this feeling that, okay, 2025 is going to be the year where you can start to do tokens more, that, you're going to have regulatory clarity. You saw the nominations of Scott Bessent. You saw, Howard Lutnick over at Commerce. You saw people who were, for the last few years, incredibly bullish on crypto and the things that were happening on the innovation side. And then very quickly, you started to see, David Sachs elected as the crypto and AI czar for the United States under the Trump administration. So there was a lot of things that started to happen pretty quickly after the nomination. And so I think that really kind of moved Q4, along pretty nicely. In Q1 in 2025, just as a reference point, we've already done about $800 million worth of deals. And so that is a healthy amount of numbers. Usually when we're doing about $2.5 to $3 billion, for the last few quarters, $800 million, throughout, first, the kind of the completion of January is not bad. It's nothing to sneeze about. And it's about 133 deals. What I'm bringing caution to is that the number of deals is fairly low. Last year in Q1 in 2024, we did about 600 deals, give or take. We're running right around, if we were kind of forward out, for the rest of Q1, 133 deals, get to about 400 by the end of Q1 of 2025, which would be lower than what we saw in Q1 of 2024. And we're, as I said, again, $800 million in January when we did, roughly, about 2.5 billion, this time last year. We're on track. We're not seeing this huge kind of, 2021 kind of throwing, as much cash into the system as humanly possible type of, kind of scenario. And so I think that was a little surprising. I think people thought, the gates would be open, the flood would come, but, it's been more muted. I think we're on target for a pretty decent quarter. But again, it's been a little bit more muted than I think some other people would have thought.
Okay,
and so,
yeah, let's get into like what actually happened with the executive order here then, right?
Yeah.
So you've got the establishment of a working group. You've got the group is going to be tasked with developing a federal regulatory framework for digital assets, focus on market structure, oversight, consumer protection, et cetera. You have the repeal of SAB 121, which obviously was a pretty damaging from an accounting standpoint. Maybe that opens the door for some banking integration. What are you looking for then in terms of, again, sort of these longer term private market deals on the heels of some of these specific Washington groups and developments?
One of the things is that you start to think is that more capital is going to come in here right now. In terms of the liquid market cap, as we've been hovering around 3 trillion, 3.5 trillion, 4 trillion, give or take. For the illiquid markets, the venture markets, you had huge years in 21 and 22. And then for the fundraising, for new funds, there was, roughly about 70 or so funds that were able to raise, on average about $150 million each. It was a pretty bad year in 2024 for new fundraisers. And with not having a lot of new capital and dry powder into the market, I think SAB 121 being repealed, I think the new executive order, I'm thinking that, the allocators out there, the big family offices, the institutions start to say, okay, well, this is going to open up the banks to start to be able to custody these assets. And, for instance, as we talked about in our write-up, the CEO of Bank of America was on CNBC last week, and he says, if the rules come in and make it a real thing, you can actually do business with, digital assets, you're going to find the banking system come in hard on the transactional side. And he said this in Davos last week. Those types of things start to be really important because the institutional investors with large pensions and endowments, they want to make sure that the assets are custodied the way that they're used to. And so that, I think, is going to be a settling kind of a sentiment for them. They're going to realize that this is more of a hardened institutional asset class versus relying on some of the likes of, the Coinbases and the Anchorage Digitals of the world. What I also talked about is that to be able for the banks to start to getting in here, it's going to cost them some money because they need to have hot and cold wallet, architecture. They need to have MPC, multi-signature controls. They need to have air gap signing systems. There's a lot of infrastructure that's going to come into this. In kind of what we know from the venture side and some of these deals and some of the pricings that some of these infrastructure pieces cost, it might cost the bank 30 some odd $1 million in year one to try to get themselves ready to do these things in a more compliant manner and in a way that they're used to. And so I really think that based off of that, you're probably going to see like the tier one banks, the larger banks, be the first movers in the space. The smaller regional banks, I think, are going to probably leverage some of the state frameworks, and particularly the ones that were in like Wyoming and Texas and Nebraska. In Wyoming, you had the special purpose depository institution framework, which I think a lot of the kind of the more regional type of banks are probably going to take a look at in terms of creating patterns and be able to do things. I thought really that, as I said again, the tier one banks are probably going to be the first in line to provide a lot of the more institutional custody solutions. I do think the regionals, the smaller ones, are probably going to start to lever the relationships that they could absolutely have with Coinbase or Anchorage Digital and some of the pre-existing vendors that could provide them services. Because of that, if they rely on more of the third parties out there versus building things internally themselves, I kind of think that the smaller regional banks are probably going to be able to move faster because they're going to be relying on already existing partnerships. So I think that's going to be important too. Again, we want to have this industry really become hardened with the infrastructure and support, large amounts of capital come in here, millions and billions and trillions of dollars. The real big thing I think is going to be important for us to watch in 2025 as it relates to the EO and some of the things that have happened over the last week or two is insurance. Right now, for the industry, Lloyd's of London has basically been one of the only providers of insurance in the industry, maybe a few others, but Lloyd's of London is the predominant one right now. It's been discussed out there that AIG and Chubb have looked into the industry, into the asset class. If they're able to come in and be able to provide insurance, that's going to be really important for this overall kind of new infrastructure, new banks coming into the space. They need to have that insurance layer on top of all the things that they build. And so if they're able to do that, I think that's going to be important, again, for 2025 and this growth of more assets coming in. So those are some of the things I talked about, in our analysis of what's happened so far.
Yeah, that's great. And I think, clearly the market is at an inflection point here, right? One of the things I've always said is, from a regulatory standpoint, certainly here in the U.S., we've gone from completely restrictive to, call it 6 months ago when Trump first started campaigning, in a pro-crypto voice. Maybe we went from restrictive to neutral. Then post the election, we've gone into a little bit of a sort of a hype and optimism phase. And ultimately, the next step is, can we actually get real regulation that actually drives real assets and real interest in the space? So we're somewhere between that kind of hype and real traction phase right now. I guess the key question, isn't really whether traditional finance will enter this space at this point, but rather how quickly the industry can scale its infrastructure to meet the incoming institutional demand. And I think you lay out a good case. We're bumping up on time here, so I think we'll end it here. But I do encourage everybody to go into our blog on our website and read the full piece. David did a really nice job of laying out all of the different factors here, from banking to insurance, from to Washington, and how it's going to impact the sector. Give us your thoughts as always. Check out the blog. Love to hear from you, and we'll be back again next week. So David, as always, thank you for joining me. And that's our 2 Satoshis for this week. Thanks, everybody.
Thank you.